When Dr. Michael Burry talks, I listen. He has a history of incredibly accurate and very thoughtful predictions that largely fall on deaf ears. He even likes to think of himself as a Cassandra, seeing things play out well ahead of others, calling it out, but largely people ignoring what he has to say, much to their own detriment. For those that don't know about his predictions, he called the great financial crisis, as depicted in Michael Lewis's The Big Short. If you've seen the movie, the book's even better. And he bought GameStop, and he advocated for shareholders for GameStop, sending a letter to management before the big squeeze where the stock went parabolic, going up several 100%. He also tweeted near the recent GameStop peak, calling out that if you made money based on knowing that he was invested, you should probably get out, and he's glad that you made money. So it's interesting. Like his calls are incredibly prescient, and he has an incredible batting average, yet still people don't listen to him. For example, he's recently started talking about how he's short Tesla. And, some people like to think, how come he's been able to make these incredible calls? Is it his personality? Is he lucky? Is it he's just finding the right spots? I personally think it comes down to a certain type of genius. A genius for spotting dry tinder. And what do I mean by that? I mean, he's able to look at an investment landscape and say, wow, there's a lot of dry tinder here. All it takes is a little spark, and you have this exponential change, a dramatic change, where it goes from a nice looking hill to complete inferno. Dramatic change in the setup. Now, that could mean, for example, with the great financial crisis, what he saw was that home prices were going like this while income was effectively flat. And he said, well, wait a second, that can't be sustainable over several years. And so that he went digging into, oh, wow, they're writing lower and lower quality loans. I could bet against these loans because they're being traded or they're being valued like they're pristine, whereas the quality of them have continued to decline. GameStop, another similar setup where it's a lot of dry tinder, a dramatic setup where it's a small change can result in a dramatic repricing, where over 100% of the shares are short. What if you get, and who knows where it comes from? For that, he didn't know, Wall Street Bets is going to be the one that pushes it forward. But if you have a setup where over 100% of the shares are sold short, all it takes is one incremental buyer that causes the shares start, going up. You get a potential short squeeze. You make hundreds or even thousands of percent. So I'd advocate that, if you're to judge Dr. Michael Burry as an investor, it's a certain genius to spot these setups, spotting just this incredible dry tinder where all it takes is a little spark to get a completely different scenario, a completely different re-rating of assets. So if Dr. Burry is one of the greats when it comes to investment predictions, what's one of his latest predictions? And this is where it gets interesting because he compared Cathie Wood's ARK investment funds to other investment funds that have collapsed in past market cycles. So should that bear as a warning to potential investors or existing investors in the ARK funds? I personally do think that, once again, when Dr. Burry speaks, you should listen. He's incredibly, he tries to be incredibly rational, logical, and he's looking for setups that I think are quite asymmetric or where there's a lot of dry tinder and the potential for a dramatic change. And so I wonder if he's seen that same thing with ARK. And I'll go into one specific aspect with ARK that might just be the cause for him thinking that. So before digging in, a quick plug about what you're watching. So for those that are tuning in for the first time, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find exceptional companies and unrivaled investments. Normally, my focus is to try to find potential multi-baggers, types of companies that can go up hundreds or thousands of percent. So if you're interested, make sure to subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to try to find potential multi-baggers, go to unrivaledinvesting.com, click on Journey. So let's dig into this setup And what did Michael Burry have to say about Cathie Wood and the ARK funds? So here it is. This is Cassandra as the handle, Michael J. Burry on Twitter. Shades of Gary Pilgrim and PBHG growth from the 1990s, or Gerald Tsai or Jerry Tsai and the Manhattan Fund in the 1960s. ARK Invest is defining an era, just like these two prior investors. If you know your history, there's a pattern here that can help you. If you don't, you're doomed to repeat it. What is the pattern? What is he talking about? And he retweets an article by the Wall Street Journal that I think is worth reading. It's in its entirety by Jason Zweig. I love Jason Zweig's work. Let's go further to understand, well, what does he mean by Gary Pilgrim or Jerry Tsai, and what is repeating? So Jerry Tsai, he was a billionaire. He became a billionaire investor who helped build Fidelity Investments. He sort of got picked over in terms of as succession of Fidelity, so he launched his own firm, and he had a very successful momentum-driven strategy. I think it was called Manhattan Funds, where he was owning these high flyers regardless of valuation. It was based on narrative, like, hey, does this story, is this a good story stock? Is this a good momentum-driven stock? Does the price action, warrant, continuing to own the shares? And he did extremely well for several years, and that success brought other investors to invest in him. So people saw the success that he had, and that's what led to him becoming a very successful investor, very wealthy for himself as he built up his asset base. As people see good performance, they chase good performance. But ultimately, that Manhattan Fund that he launched lost 90% of its value or assets under management from the late 60s, when the underlying market also fell. But in particular, many of these high-flying stocks like Xerox or Polaroid, some of his key holdings were hammered. So this is one of the investors that Dr. Burry calls out, and sort of saying shades of what you see with ARK, where you see successful investing sort of regardless of valuation, focusing on momentum, focusing on things that just do well, narrative-based. What's the narrative that drives this, regardless of valuation? And ultimately, glamour stocks. Stocks that look sexy that everyone wants to own. What else? So then there's also Gary Pilgrim. This was the first person that Dr. Burry calls out, where he says he launched his own, his background, and this is also from Wikipedia, where he launched his own mutual fund in 1985. By 1996, was the #1 performer among all equity funds over the previous 10 years. So once again, you get a ranking like that, and then it becomes self-defeating as all this money moves in, and it becomes harder for you to move. It becomes harder for you to continue to have your sort of adept investing skills, because you become a lot, instead of a little skipper, you're now the Titanic. It's a lot harder to move around, and people chase performance. Investors chase performance. When they see a good return for a few years, they go, oh, it's going to continue. That's not always the case. If anything, it makes it harder now that they own more, now that they have more assets under management. But he was up 93%. So a few years later, the fund sort of went nowhere for a couple of years, but then was up 93% in 1999. The dot-com bubble, woohoo! But proceeded to crash along with the rest of the market in the ensuing years. An investigation later ensued, and the company effectively folded in the years ahead, the mutual fund. It was sold to another shop. So when he compares ARK Investments to these two different investors, that's a pretty damning comparison. Now, I might say it rhymes or, shades of, but it is worth sort of calling out, what exactly he said. There's a pattern here that can help you. People chase performance. Assets under management swell dramatically, making it much harder to repeat that exceptional performance. And then what's the potential dry tinder that Dr. Michael Burry is seeing here with Cathie Wood? And this is the interesting point. So you see assets just flow dramatically higher in the last year. Over $20 billion flowing into several of their different ETFs. Each day, several $100 million more flow into their funds. And it's all based on chasing the performance. And look, their performance year to date has been great as well. But here's an interesting little part in the article, in this Wall Street Journal article, that I think might just be that dry tinder that caught Dr. Burry's eye. Where he goes, according to FactSet, 43.5% of ARK's total equity holdings, so their stocks, are in stocks of which the firm owns at least a tenth of all shares outstanding. I.e., what they're saying is nearly half of the stocks that ARK holds, they own a large stake in, over 10%. At Vanguard Group, by contrast, only 10%, less than 10% of total equity positions are in such concentrated holdings, meaning more than 10% allocation. If ARK ever needs to sell any of those holdings, who will buy in enough bulk? Who will buy in enough bulk to keep prices from collapsing? That, I think, is $1 billion question. And that, I think, is the dry tinder that Dr. Burry sees. Let me dig in a little bit more. So this was one of their most recent quarter's portfolio updates that aggregates everything across the ARK funds. And you can see their holdings, for some of these top names, are almost 20% or over 20% for several companies. They own more than 20% for several companies. If the tides change, tides aren't always favorable. If the tides change, is it possible that they're going to be in a very tricky spot because they own such a large stake that keep in mind, it's in a very public way with ETFs. People see what your positions are. That all these other investors go, wow, a person that owns 1/10, or that ARK, which owns 1/10 or 1/5 of this company, is getting outflows. And it would mean, admittedly, it would have to be a change in investor perception. It would have to be some sort of spark that's unexpected. Much like you could argue housing prices. There's a spark. People stop being able to pay it. The dry tinder builds and builds. Or GameStop. Oh, the short interest relative shares outstanding. It builds and builds and builds, creating that dry tinder. And all it takes is that one little spark with Wall Street bets. And then, is this the same sort of thing? Now, no one knows exactly what that spark is in advance. But is this the dry tinder where if they start having outflows, do all the bloodthirsty hedge funds start thinking, and I don't mean that I'm not saying that in a mean way. I'm saying that I think in a way that I'm trying to be as accurate as possible. I think that's the way they play their game. It's sort of like saying a shark is bloodthirsty. That's describing the nature of the animal. And so if you start seeing outflows with ARK, then do they start hammering these larger positions? Let's say these positions where they know ARK owns 1/5 of the company, and they start shorting it ahead of them effectively becoming a forced seller. It's almost like a GameStop, but in reverse, the opposite of a GameStop. Instead of this big short interest, there's this huge owner, and they have to sell, and we know they have to sell. And if there's enough redemptions, there's not going to be enough liquidity in this market for them to get a good bid. In which case, the price for a lot of these assets start to fall. Now, Cathie would argue, well, wait a second. You know what? I own plenty of liquid things like Tesla, and I could just sell out of that. But when you have a completely open book, like these ETFs, people will know what you own. And so they're going to say, oh, well, okay, then we're going to attack Tesla as well. Because they're going to see you're going to have a liquidity problem for, let's say, 40% of your portfolio, 50% of your portfolio. That's a big deal. And it's a lot of dry tender. I'm not saying it's definitively going to happen. But what I am saying is that Dr. Michael Burry does have I'd say a genius level power of identifying these asymmetric setups that sort of go, wow, if you just have this little aspect, it dramatically changes the setup. To the point where people are already talking about it online. Here's EvaDaddy90 on Twitter saying, Wall Street Journal article says ARK has almost 50% of the fund in stocks where they own 10% or more of the company. We already know that. Cathie D. Wood, this is pretty ballsy, calling out, calling her out, saying, I look forward to feasting on your carcass when flows turn negative. Going to be easy to get some predatory shorts going in all your small caps. That's what I mean by sharks. There's going to be a lot of folks like this. Just like, I would say it's no less predatory than the folks that were looking to also buy into the GameStop short squeeze. People will see those flows and know there's some stocks here that are going to be really illiquid or really tough for, if you own 10-20% of the stock, you're a large owner of it. People will know you got to blow out of it or you got to blow out of this. So I'd say it's a super tricky position to be in. It's something to watch. Definitely a big risk I would consider for ARK investors. When it changes, when that spark happens that turns a normal field into inferno, I don't know. But at some point there will be that spark, I suspect. Just like Dr. Michael Burry has called out and successfully predicted in the past, often on deaf ears. So if you enjoyed this video and you want to learn more about some of the exclusive content that I do, particularly usually focused on exclusive multi-bagger picks, go to unrivaledinvesting.com, click on Journey. Some more exclusive content like where are we in the market, what are my thought process on what are sort of the signposts on this investment journey, thoughts about hedging against potential market collapses, and also my monthly potential multi-bagger, where each month I try to post or call out one company that I think has potential multi-bagger potential. And I do have a total overview of my portfolio. So each month you can see everything, all the percentages across the whole portfolio. There's also an educational series like what I called out about learning how to hedge against, potential market collapses. I have a link to the full catalog of contents in the description of this video if you're interested. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. Click on Journey, and if you enjoyed this video learning about Dr. Michael Burry's sort of concerning predictions about the ARK funds, make a point of subscribing and hitting that thumbs up button. Thank you so much for watching.